Venture is, which I found out very recently, venture is just a short for adventure, right? It was reserved for businesses that was fairly adventurous in its very nature. The reason why we have an ownership in the company is because we have skin in the game. We have vested interests. Think of venture capitalists as analogous to mutual fund managers, right? As a gardener or a farmer, to enable the seed to grow in the best possible manner, in the quickest possible manner. Now, what is still not solved for in the EV value chain, especially in a country like India? The battery part of it is not solved for it. As of today, there is zero battery manufacturing capacity in India. Now, I think because technology is so democratized, I see sometimes founders just writing to VCs on Twitter, right? Does this excite you? Can I get a meeting with you? I think valuation is more of an art than a science. A great pitch in itself will not translate into an investment, right? Okay, taking a step back, deep tech innovations typically come from or historically have come from academia.
Hello Sunil, how are you doing?
Hi Pratibha, doing well. Thank you so much. Thanks for making the time and giving me the opportunity to be a part of your explorations and your journey. Thanks to Navneet as well, who's behind the camera.
Well, without any further ado, let's get started with the first question that we ask all our guests, right? How's your day been so far?
Yeah, it's been, for the record, we are taping on a Saturday. I'm in office on a Saturday to do some work, but can't complain. I think I had a late start to the morning, which I really appreciate on a Saturday. But then, starting with work and catching up with emails and making time for you guys to be a part of this.
Lovely. Okay, let's get started with our first question. For someone who has not even heard the word venture capital, how do you explain it to them?
So, venture capital is essentially capital. In its primary origins, it's capital. Capital is money. Venture is, which I found out very recently, venture is just a short for adventure, right? And when this form of capital originated, it was meant for businesses or startups, businesses in general, that were essentially doing something that were not ordinary, right? That it was reserved for businesses that were doing something that was fairly adventurous in its very nature, right? So capital for businesses or startups which want to build something is what venture capital is. How this works is that as a firm, a venture capital firm, we invest a certain amount of money in a certain startup or a certain business, and then take a certain percentage of ownership in that company. So we become owners of the company, owners of the shares of the company, along with the proprietors or the founders of the company itself. Now, once we become owners, we try to help that startup, the founders, to grow in, let's say, their product, their business, customers, revenues, so on and so forth. Now, when the startup grows, the value of our ownership, the value of the company grows, and thereby the value of our ownership in the company also grows. And then we essentially, a venture capital firm will sell off its ownership to someone else, and thereby there is a delta between the money that we invested at a certain value of the company and to where the company is today, which is at a higher value. We make certain money out of it. But as in a lot of things, not all our investments will be fruitful. There will be investments that will there will be startups that may not achieve the desired results, and thereby they may fail, they may shut shop, and thereby our investment will also go down south, right? If I were to kind of give an analogy for something like this, think of it as a seed that has a seed in the soil that has to grow into a plant, go into a tree, or so on. Our role is that of the seed will grow into a plant even otherwise, right? If it will take water, it will take sunlight, so on and so forth, and it will grow in some way or the other. But think of a VC, a venture capitalist, as a gardener or a farmer who will provide the right nutrition. We will provide the right right amount of water, right amount of fertilizers to enable the seed to grow in the best possible manner, in the quickest possible manner, into a plant, into a tree. Now, once the plant or the tree is grown, let's assume that it gives a certain type of a fruit. Then we want some part of that fruit. We sell some part of that fruit to make money out of it. But as is the case, not all seeds will grow into a tree or a plant. So there will be a certain amount of failures. But we try to focus. But even if we get one or two really good trees that can give you fruits for a very long time, that is enough for us to make significant returns on our investment.
Got it.
That's the way that we could correlate venture capital.
Okay, so when you mentioned about venture and capital separately, right? The way I look at it is, if in case I'm starting something, and if capital is the only thing that I would require, I could also take a traditional bank loan, right? Raise a debt. But what are these things that a startup would get from a VC than raising a loan themselves, except for the interest part and stuff? Because at the end of the day, they're also losing some amount of ownership that they have within a company when they come to a VC, right? How do you think?
That's true. So if you were to think about how different VC venture money is when compared to a bank loan as such, like you rightly pointed out, one, there is a certain interest, or there is a certain obligation to repay that money. That is not the case in venture capital. You are not expected to. A startup is in no way obligated to return money to investors. Venture is risk capital, right? We know that the money that we put into a startup is something that we may not see again. There is a risk of that investment going to zero, right? A bank is not going to allow you to default that easily on a loan that you have taken, right? Irrespective of whether the startup does well or not, whether your business does well or not, you are expected to return back that money to a bank, right? A bank does not, the reason why we have an ownership in the company is because we have skin in the game. We have vested interests, right? A bank does not have vested interest. A bank only wants their money back along with a certain amount of interest that they charge, right? What we have is essentially, we invest our time, money, and effort to help that startup grow, not just with capital, but other resources that are necessary. Helping startups figure out business strategy, helping startups with the right legal guidance, helping the startups to have corporate practices, good corporate practices, ethical practices, business practices, helping them perhaps hire the right set of people, so on and so forth. We thereby increase the odds of that startup actually doing well through our efforts. A bank, on the other hand, will not do that. Their job is to lend capital and make sure that the interest is paid on time, and then the full amount is essentially returned to them, right? So primarily, that is what a financial institution like a bank would do vis-a-vis a financial institution like a venture capital would do. I think the more important aspect here is that a bank is not necessarily the right option for a bank may not be the right entity for a young startup to go to, right? Because there is already a fair bit of uncertainty with the startup, that you don't know whether you have the right idea, you don't know whether you have the right right product that you need to build, the right customers that you have to go to. You don't know, you're still figuring it out, right? A bank loan is best suited when there is certainty, right? When you know that my business model is working, when you know that there are 100 customers waiting for me, and in next 3 months I'm going to have 500 customers, and I would make money out of that 500 customers, and that money will be used to repay that loan, right? So when you have certainty in your cash flows is when a bank loan makes a lot of sense. The venture money comes in as risk money, that venture investors, venture capital firms will provide money to startups. If you want to start up something, we give you money based on your vision for the company, on the idea that you have, and the potential of that idea to grow and realize that particular vision. Right? That is a part that banks are not best positioned to underwrite at this point of time. A bank works well when you are a business that is churning out a few lakhs or a few crores of revenue every year, and they have predictability that you will make more and more money if you take the bank's money and invest it in a certain capex or a certain capital equipment or a certain team and so on and so forth. They know that the company can go and repay that money back. Venture investors work very differently.
Okay, in that case, what is the difference between other institutions also, right? Like an incubator or an accelerator or government grants, for example.
Yeah.
Like there are different forms of capital that folks can raise. Like what is the difference between?
Primarily, not so much in the sense. Okay, there are differences, there are similarities. There are similarities in the sense they all target similar organizations. They target young startups or organizations that don't have a lot of capital, that are other sources of capital available at their disposal. That is what they all do. Incubators, accelerators, government grants, and venture funds are usually early stage venture funds are all for organizations that don't have a lot of access to capital at the very beginning. Now, how are they different? Primarily, they are different in terms of the quantum of capital that they can provide. Right? An incubator or an accelerator in a country like India or government grants can be anywhere between a few tens of lakhs to a few crores as such at best, right? A venture capital fund has the capabilities of putting multiple crores, multiple tens of crores, or even multiple hundreds of crores. Thereby, incubators, accelerators, and government grants fall a little before the role of a venture investor essentially comes in, right? So they provide 10 lakhs, 20 lakhs, 50 lakhs for you to perhaps build a certain a working prototype of the product, so that you can go to someone who puts in more money and say and establish your credibility, right? The startup, the founder can essentially go and say, hey, I used 50 lakhs of money to build a prototype of a certain product. This is how it works, right? But this is not a product that I can sell to the final customer. So I need more money to do that. If I need more money because I need to build a much more refined version of the product or a bigger version of the product with more, specific feature sets, which I can't afford to do right now, or I need 5 more people to build it. I can't do it myself, or I need to have certain hardware equipment to build it. Today, I have done it using 3D printing or some prototyping technologies. But if I have to actually put this in the hands of a customer, I need to do it. I need to do some machine design. I need to do it with a certain type of an aluminum, a certain type of a steel, which may be more expensive and thereby give me more money. I am proving myself worthy of taking, let's say, 10 crores from a venture capital fund by doing a certain amount of work beforehand to show that I know what I'm building. Right? I have proof in front of my eyes. It's not in the air. I'm not talking about some fantasy idea that I have and I'm asking you 10 crores. I am proving myself capable and deserving of more capital because I have done this. Which very honestly is how, after taking, let's assume that we have funded a particular startup, a venture capital firm, a seed stage venture capital firm has funded a particular startup. If that startup has to go and raise more capital 10 months or 12 months from now, then they would have to go through the same exercise of saying that, hey, I took 10 crores from investor A. This is what I have done. Thereby, give me more capital. I will go and do a lot more. Right? The next investor also puts the same set of filters downstream as well.
Got it. So, for example, if in case I'm starting a startup today, what is the probability of me approaching to a VC and getting it funded than me going through an incubator or an accelerator, proving something and then coming to a VC?
Difficult to give a blanket answer there. Depends on what you are building. You will not see a lot of, let's say, for example, software startups and e-commerce startups or marketplaces traditionally going through incubators and accelerators heavily. Why? Because the cost of technology or cost of building something like that today is not very high. Today, tech is the tech stack that involves in building those sort of products are fairly democratized. They are reasonably available. You can raise a few lakhs or a few tens of lakhs. You can put your own money. You can bootstrap it, or you can go through some angel investors, your friends and family. You can raise some money and you can build those things, right? And then you can come with a fairly working product directly to a venture capital, investor as such. But imagine you're building something that is more hardware and more in the physical world than in the digital world, right? Let's say you're building, for example, something in space tech, right? Where we have about 5 investments at this point of time, right? So let's say you're building something in space tech. Let's say you're building a rocket, for example. How do you build it without money? How do you build rockets without money? And how much money is enough to show validation that you can actually go and, how much money do you need to even build that even prototype of sorts? What is even a prototype in the rocket world, right? So in those cases, you have to get some initial support as well before you go to an investor, because you need to show something there in the hardware world, which is often more expensive than building a software product. What do these incubators, accelerators provide you is access to certain facilities where you can build the hardware. They can provide you labs, like access to labs. They can provide you access to certain types of machining equipments, right? Where, let's say, you have to put in a few lakhs of rupees, but you don't have to invest in the machines to build those products themselves. You may have to still invest in the material that is used to build the product, but not necessarily in the machine that is used to build it. Right? So thereby, when you go to an accelerator or an incubator, you will be able to do a prototype or an MVP with which you can come and raise capital from a VC investor. A software that is doing something more in the digital world can build a lot of these sitting in their houses and in their own garage with very minimal investment when compared to what happens in the hardware world. That is where I think today more startups, the more hardware startups would find it beneficial to go to an incubator or an accelerator, access the facilities that they have at their disposal, build something substantial or build something that is credible, and then come to an investor.
Got it. And a very naive question that I have is, in terms of the expertise that the VCs already have, right, with respect to a specific tech, because you guys look at a range of products in your portfolio, a range of companies as well. How do you divide your sectoral specifications? Like, okay, in this sector, we are going to invest in this kind of company. Let's say out of nowhere, we have someone working on space tech, for example, like you mentioned, right? It's not necessarily that a VC would have experience about everything about a company. Then how do you go about in cases like that?
I think in general, most VCs or in general, VCs should know what they are investing into, right? It's important for us to understand that industry. It is important to understand who is doing what in that industry already, and whether there is even a chance of the investment, the startup that you're investing in, to come out successful in that industry, right? So how do we do this? Our approach, and I speak for us, and I know a lot of my colleagues in the ecosystem in other VC firms also do this. We build what are called as investment theses, right? These are essentially our deep dives into particular sectors to understand whether they are investable or not, right? And if they are investable, what part of the value chain in that particular sector should we focus on, right? Let's take an example, for let's say in the EV space, because we are able to correlate to EVs much better, right? Now, if you look at the EV value chain, you will have people who are building vehicles. Let's keep them at the center, who are building the actual 2-wheelers, 3-wheelers, 4-wheelers. But to support them, you need people who are providing the components that go into the 2-wheeler, 3-wheeler, and 4-wheeler. There are motors, there are batteries, there are tires, and so on and so forth. Then let's assume that let's assume a 4-wheeler now. Let's assume the car is built. Now, once the car has been built, you need to solve for, let's say, the charging infrastructure, right? Somebody has to, the charging facility should be available for you to charge that vehicle. Then perhaps somebody also has to have repairs and maintenance and servicing ecosystem, right? There should be service centers, there should be mechanics. People should know what to do if the car actually breaks down or something goes wrong. There should also be perhaps someone who will help you finance buying that EV, somebody who provides loans to buy that EV as such. An EV car is different from a IC engine car. So you have to underwrite those risks very differently. So somebody's providing a certain type of a loan, right, to build. So there are different aspects to this, and then there is an after service, like after sales industry, right? Like let's say the car you want to sell that car. Is there a second hand marketplace or a market? Somebody's solving for that, right? Then there is also a part of the value chain which says, okay, the car's life is over. Somebody wants to sell the car, but can that battery pack be used? Can we recycle that battery pack? Can you recycle some other component of it? So all these industries are a part of the overall EV value chain, right? Now, when we do a landscaping or a thesis exercise, we will identify these different parts of the value chain. Then we ask ourselves, where do we think is the largest opportunity today, right? And that's one lens. The second lens to put there is to say, where are we best positioned to make an investment and support the startup, right? Let's say, for example, we talk about, again, taking that EV example. We will today, if there are so many companies doing, let's say, EV two-wheelers today. Right? Of course, the likes of Ather and Ola are market leaders, but in the startup domain. But in addition to that, you have the likes of Hero, TVS, all doing their own vehicles themselves. The legacy automotive companies are all doing their own vehicles. Now, in March of 2025, how does a new startup which wants to build an EV two-wheeler, starting today, compete with these people there are so many players building it? How do you compete with those people? Because for you to build a vehicle itself is going to take a couple of years. You have to build, then test, and then do marketing, sales, and so there's a lot of activities involved. So then we say, okay, this is a highly competitive part of the value chain. May not be the best possible opportunity for a fund like us to fund a startup in the early stage, right? So we say, okay, maybe this is not an area that we should heavily focus on. Now, what is still not solved for in the EV value chain, especially in a country like India? The battery part of it is not solved for it. As of today, there is zero battery manufacturing capacity in India, right? We don't make lithium-ion cells in any respectable scale in this country at this point of time. We are doing it at certain pilot scales, but there's no commercial lithium-ion manufacturing capacity that is available in the country, right? And we are importing 100% of our cells that go into the EVs, usually coming from a hostile neighboring country, like, so thereby, is this something that we can, it's a white space in the Indian market. It is definitely directionally the space where we need capabilities as a country. It can become a geopolitical thing because this is very integral to how our future of our mobility is imagined in India today. So maybe that is an investment that is worthy of pursuing. If you are building something that is fairly differentiated and unique, right, in its offerings, that solves for the Indian battery problem in the Indian customers, in the Indian auto OEMs, then perhaps there is a great opportunity for that startup to grow and take a substantial position in the market. Because the market is very clear. We know who is going to buy these. It is two-wheeler, three-wheeler, four-wheeler companies. They are already buying it from a different place today. You don't have to educate the customer as to why a battery is important. They already know that. If you are going to offer something that has the necessary capabilities, but is also cost competitive when compared to what they are getting today, then you have a ready market that is there, right? So then we say, okay, maybe that is an opportunity for us to focus on, right? So that's the way you map out a thesis. You spend a lot of time. How we do this is we kind of read a lot of reports that have already been published on this particular space. We read broader things on the internet. We look at LinkedIn posts, we look at Twitter, we look at Reddit. We speak to various stakeholders, right? We speak to companies that are building two-wheelers. We speak to companies that are two-wheeler, the auto OEMs. We will also speak to people who can be potential users of this particular product, potential customers of the product. We'll speak to people in academia, right? Understand what are they seeing are the emerging trends in this particular space, right? We'll speak to people who are in the industry itself, right? Let's say someone in the chemical industry, right? What do they think, how these chemicals are, the chemicals that are used to make these batteries, are they readily available? Is that supply chain sorted out already, right? So we try to speak to these various stakeholders and see, we also speak to other investors abroad, right? Like investors who invested in battery startups previously, right? For example, we'll speak to them and ask them what has their experience been, what are the common challenges that they have seen, or what has worked for them. Not that we will take it, as is from there to here, but it's an additional data point that helps us figure out where we want to focus on. Then when we do all these things and gain some confidence, we'll say, okay, who's doing this in India? Who are the startups who are building batteries or cells in India at this point? Then you prepare a list, right? And then you say, okay, whom can I speak to, right here? So that's how we essentially try to gain an understanding of a particular space. The best way to do this is to do this proactively, right? Where you are doing this even before that sector becomes a very hot thing, right? Otherwise, you're always playing catch up, right? So you need to foresee some of these sectors initially and try to learn as much as possible about them and try to identify startups who are building in that particular space. There is another way that you can do it, which is to be reactive, right? If let's say a startup comes saying that I want to build cells in India, right? Then okay, if you start thinking, okay, they're saying cells, okay, where does this cell go? Okay, there's an EV OEM, then this is the value chain. If you start doing all that exercise after the startup comes to you, you lose out on time, right? Because the startup is not going to wait. There may be other people who would have already done this exercise, who would have already done this homework. They will probably say, okay, this is a great opportunity, and they'll go ahead and put money, right? So if you do this proactively, you are well prepared to evaluate a particular startup or evaluate a particular opportunity when it comes to you. Else you end up playing catch up, right? So this is how we essentially end up preparing for what sectors we want to invest in.
Got it. And you mentioned a very interesting word there, market ready, right? When I'm looking at an idea, to what extent should I be understanding the market like? What is the degree of penetration that people already have within the market, or how do I understand the term market ready, right? Because I know that you work specifically on deep tech stuff. So there may not be enough market penetration at the moment, but it's an innovation at the end of the day.
Yeah.
So how do you look at?
Yeah, I think that's an interesting question, which is something that we encourage all founders to think about heavily before they think of even starting to build in a particular space, right? The thing that we have observed is that in India, taking a step back, deep tech innovations typically come from or historically have come from academia, right? They've come from projects, research that has happened in academic institutions. They get taken over by either the defense or the industry, and then they start getting commercialized. So the people who build these technology stacks usually come from a background in research and not so much from a background in business, right? So they are building something because they think that the technology has value. Today, we encourage founders, and founders also come from that background. They come from a background in technology, right? So it is not very apparent or natural to them to see where can this product be essentially be used, right? If today we've had instances where we've spoken to some founders, not all of them, of course, but some founders who will say, where can your product be used? They'll say, this can be used anywhere. Right? Okay, who can use it? Oh, anyone from a 10-year-old to a 70-year-old can use it, right? Perhaps that is the case. But what have you figured out as an entrepreneur? What have you figured out to say, hey, maybe 10 years to 70 years, everyone can use it. But perhaps the best people who are positioned to use this, who have a need for a product like this, and who are willing to pay for a product like this, are in the ages of 30 to 35. They earn a certain amount of income every particular month. They live in certain parts of the country. They live in certain type of houses. They eat a certain type of things. These are the traits of my customer. These are the people I should I should focus in a targeted manner so that I increase the chances of me making a sale, right? This is a very consumer focused example. If I have to look at it from a business focused example, let's say you are building, let's say again, let's go back to that example of batteries and cells, right? If let's say you're building cells, yes, cells are used in remotes, cells are used in laptops, cells are used in EV two-wheelers and four-wheelers, cells are used in rockets and space stations, right? So where do you want to sell? Your watch has a cell, right? So where do you want to go after? Whom do you want to build that cell for, right? You just saying you want to build a cell is not good enough today, right? You need to know who is essentially going to use it, right? Now that happens when you actually go to customers and figure out if they actually have a problem, right? That becomes extremely important. Rather than building a product and then going to the customer and pushing that solution onto them and saying, okay, hey, I've built this, why don't you use it, right? Then the customer will be like, hey, I don't even have a problem. I don't feel a need for something like this. So even before you build out something, like this is what we tell entrepreneurs today, even before you start to build anything, validate if that is a market need, right? If the market is even, forget about the product being ready for the market. Is the market even ready for accepting that product, right? Are they saying that, hey, here, this is a problem that I'm losing sleep over, right? Every night I'm figuring how do I solve this particular problem. That indicates urgency, right? It tells you that the customers are really crazy for a solution, are looking out for a solution. If you have a problem statement like that, and then you want to use a really good technology to solve that problem, then you can find customers very easily, very quickly, and they would be more than happy to pay sometimes even a premium to get that problem solved, because that is how important that problem is. But on the other side, if you build something in the lab purely for the love of it, and then say, okay, let me go to the customer, you don't know whom to go after, you'll go through the internet and say, hey, which are the 5 industries which require a product like this. Then you'll say, okay, 5 industries. Then you'll go to one person here, you'll go to one person there, you'll put this product across to them. They'll say, oh, okay, yeah, we're already getting this from some other vendor, we don't have a problem, we have a long-term contract with them, I can't come out of a 5-year contract and disrupt you. When I'm renewing the contract, why don't you come to me? Or they will say, hey, this is not, your product has 10 specifications, I want only 7 of them, I'm not willing to pay for the rest 3. Right? Or they will say, okay, you already have 10 of them, but I don't need any of these 10. The platform is good, but can you build 2 very specific features that I want, right? Or they will say, okay, this product is too expensive for me. Find a way to reduce cost, right? Or they will say, I want to, my product, the product that I'm using today can work in temperatures of 150 degrees Celsius. Your product is not working. Your product is not working at that range. Show me that your product will work till 150 degrees Celsius, and then we will talk about business. So all these things come up when you have not spoken to the market, when you haven't spoken to the customers and figured out whether there is a particular problem statement. If there is a problem statement, what is the solution that they actually want? What are the specifications that you have to build for? All these things will become clear when you speak to the customer. It's an extremely important part of building a startup to understand what your customer actually wants. First of all, who your customer is, and then what exactly do they want. Because the customer always have, for example, let's assume that the customer always has 10 different problems, right? Is he or she more likely to pay for the top, and if we were to prioritize that, is he or she more likely to pay for the top 1, 2, 3 problems, or is willing to pay only for the 9th problem? Very likely that they'll pay for their top 3 problems. They'll say, okay, for the 9th, if you go with a solution for their 9th ranked problem, they'll say, hey, I have 8 other things that I have to worry about, and my money is precious, I have only limited money. I would rather focus on solving the top 8 problems, and more importantly, the top 3 problems rather than the 9th problem, right? So it's very natural. That's how you think of it, right? So understanding whether the problem statement that you're solving for is a 9th ranked problem or is it a top 3 problem becomes extremely important. All this happens only when you go out and speak to people in the ecosystem. It doesn't happen on the internet, right? It can't happen through searches on the internet, right? It's that part of information is not something that is readily available there. Or even if it is available, it has to be actually validated on the ground. You can't assume that just because someone has put this as a problem statement on the internet, that your customer base all of them have the same problem. They may have it to varying extents, right? For some of them, it may not be, they have only one factory, so they're like, okay, let me live with this. For someone, they may have 30 different factories, and thereby that problem is there all across 30 factories, and it's costing them a lot of money. So those are things that come out only when you speak to the customer.
Got it. This is quite interesting, but I would like to take a step back and go to the VC bit before we enter the deep tech part. So we were speaking about how we are spending money, right, in terms of VC, but where's the money coming from?
Yeah. No, good question, right? So the analogy that I usually give for this is think of venture capitalists as analogous to mutual fund managers, right? Mutual fund managers are essentially people who start a certain type of a mutual fund. They'll say, I will invest in a certain type of stocks, public market stocks, publicly traded stocks, and they take money from you, right? You are not investing in those stocks directly. You are giving it to a mutual fund manager who knows which stocks are expected to perform well, right? And he or she will go ahead and invest in those stocks, right? Think of us as analogous to that investment, that mutual fund manager. We raise capital from a bunch of people or institutions who want to invest in private markets, in this particular case, specifically in startups, right? So these are not publicly traded products or companies. These are private companies. There are a bunch of people who want to invest in private companies as well, right? Or in people or institutions. Now, they don't necessarily know which are these companies. They don't know there is a company sitting in HSR. They don't know a company sitting in Kormangla. They don't know a company sitting somewhere near, in Hebbal, right? They don't know of these details, right? So our job is to facilitate that investment. Right? So we essentially raise capital from a bunch of what we call as LPs or limited partners of a particular fund. Think of these people or institutions as, these are extremely rich people, high net worth individuals. They're family offices. They are sometimes government institutions who want to invest, who want to make investments. Right? They want to invest their capital to see better returns on their invested capital. Venture capital is one way or one platform through which they can make investments amidst all the other categories like fixed deposits, RDs, FDs, mutual funds, direct stocks investing, gold, real estate. Amongst all those other things that a person would want to invest in, this is also one other investment bucket, investment category, right? So, but since you can't invest directly in startup, you can, but very likely you don't know which are the right companies to invest in. We do the job of figuring out which are the best possible startups through developing our investment thesis, speaking to the founders, doing diligence, so on and so forth. So a bunch of people give us money to do that. We invest in these startups and we own equity, or we take a certain amount of ownership in these startups. And when those startups grow, we return back that money to the people who invested in us, right? So that's where we essentially end up getting money. That's how we channel that money into startups and then give that money back to the investors.
So in terms of mutual funds or the other investment buckets, right, it's relatively liquid to some degree, like you can draw out money.
Yeah.
But that is not possible in terms of venture fund, is what I'm thinking.
Yeah. So yes and no in a way. I would lean more to say no, because we see venture investments come in a category of long gestation period, high risk, high reward investments. Right. That's how I would broadly categorize them. When we invest in a company, we expect to be invested for at least 3-4 years, and at the upper end as long as 8 to 10 years as well, right? So if you are an LP and want to invest in startups, and you go through the route of investing through a venture capital fund, very likely that you will not be able to access the invested money for at least 5 to 7 years. Right? So that money is not, which is why if you look at the overall spectrum of investments that one could make, the VC portfolio of the investments would possibly be less than 5% of anyone's. If you had 100 rupees, you'd probably put only less than 5 rupees in venture capital private investments, specifically through venture capital. You would put all the other money in lesser riskier investments, from the safest of, let's say, PPFs and RDs and FDs in nationalized banks, from then taking a little bit of risk and saying, okay, I'll invest in, a little bit of mutual funds and stocks and land and bonds and gold and so on and so forth. You do all those relatively safer instruments on that spectrum, and then you come to the more riskier instruments like putting money in venture capital.
Got it. So when it comes to returns, how does the returns bit work when it comes to venture capital? Like, if in case I'm an investor and let's say I've invested 100 rupees and the money has multiplied by 2x or 3x, for example, let's say it's 300 rupees, right?
Yeah.
So out of that, like we said, there is also a management fee which comes with mutual fund. So how does management fee work?
So management fee also similarly works in the case of a venture capital firm as well. The idea is simple. Let's say you give me 100 rupees. I spend the life of a venture capital fund is anywhere between 8 to 10 years in a country like India. So the first 4 years, or the first anywhere between 2 to 4 years, I will spend investing that 100 rupees. Right. The next anywhere between 4 to 6 years, I will spend making sure that 100 rupees becomes 300 rupees. Right. So what that means is that I would have to help that startup grow more and more. I have to help it raise next round of capital, subsequent rounds of capital, so that my initial investment multiplies into something substantial. Right. Now, once it multiplies, then I start returning capital back. Right. How that essentially, okay, maybe even before I do that, let me clarify one thing, which is because you brought up the point of a management fee. If I have 100 rupees available at my disposal, I don't invest all 100 rupees because I need to pay for my bills as a VC. I need to pay for the team members. I need to pay for the office. I need to pay for my legal expenses, travel, so on and so forth. So we take a management fee of, the standard is about 2% of the total corpus every year, right? So if it's 100 rupees, then you take 2 rupees every year to run your organization to make the best possible investments. So over a 10-year time period, you end up taking 2 into 10, about 20 rupees out of that 100 rupees to invest in, to run your organization. So effectively, you have 100 minus 20, only 80 rupees to invest in startups. So that's essentially how the management fee works, right? Now, the 80 rupees you invest and try to make it 160, 240, 300, so on and so forth, right? 320, so on and so forth. So that's essentially how the management fee bit works.
Okay. And you also mentioned something about due diligence within startups. What are the kind of due diligences that you guys do before you even invest into a startup?
Yeah, so a couple of things become important, right? Now, what is important to note here is that different things matter to different investors, right? Depending on what stage, one of the layers is what stage you are investing in, right? If I'm coming at a pre-seed or a seed stage, which is a very early stage in the life of a startup, I have very little data to rely on, in the sense that very likely the startup is not making lots of money, right? They don't, I can't look at financials, I can't look at any sort of a customer feedback data, so on and so forth, right? So I don't have all of that available at my disposal, right? Because the startup has not grown so much. Thereby, I need to take a different lens to evaluate those startups. But imagine the startup is already making, let's say, 100 crores of revenue, and a certain investor wants to put more money into that company. They have all the financial data that they can review, and they will say, what is the possibility of this 100 crore becoming 1,000 crore revenue, right? What factors, what are the threats for 100 crores becoming 1,000 crores? Is there an increased competition, or is there some regulatory framework that might come and stop the company from doing what it is? Or let's say, for example, is the team, is there certain imbalance in that team, right? To go from 100 to 1,000 crores, you need to have a certain vertical or a certain technology in that particular expertise in that particular team. Maybe that team does not have it today, and thereby going from 100 to 1,000 is not possible. They can possibly grow from 100 to 200 or 300, but going to 1,000 is not possible. That would be the lens that a later stage investor takes in. For us at Special, we come in at the early stage. We come in pre-product, pre-revenue. About 90% of the times the companies that we invest in have not made revenue at all, have not made money at all. 100% of the times they are pre-product. They don't have a product also, right? They're still building out the product. That's the stage that we come in. For us, the lens that we will take is to gain a lot of confidence and trust on the founders. This you have to do at any stage, but it becomes even more important at our stage because we don't have substantially a lot of other things to bank upon, right? So we spend a lot of time engaging with the founders, speaking to them, understanding their core motivations to build something like this. What is it that they expect to gain out of this entire journey of entrepreneurship? What is their vision for the company? Where do they see this company in the next 5 to 8 years to 10 years or so? We gain a lot of confidence. What are their strengths? What are their weaknesses? What's essentially troubling them the most? Do they have a good co-founder or a good dynamic with their co-founders? How are they thinking about building a team? Those are aspects that the softer aspects become extremely important in our evaluation of a startup. In addition to that, quite important is what are they building? Is it something that, let's say, what is a market for a product like that? Like, what is competition like? Are there 50 people building something similar, or are there only 5 people building it? If there are 50 people building it, then it's almost always a cost competitive game, right? You need to price yourself better. Even if you offer great features, sometimes the customer may not be willing to buy it because it's too expensive. So you need to, if you're giving something that 50 other people are giving, then you need to be really sensitive about price, right? But if you're building something that only 5 other people are building, then, and there is a strong demand and a strong market for a product like that, then you have more control over your pricing strategies, right? So we try to understand what is the defensibility of this particular company in itself. We do all these usual market analysis, market positioning. We look at competitive landscape. We try to understand. What is their business plan with the money that they are raising. What do they want to do, and what they want to do. Will that give them enough of a leverage to go out and raise the next round of capital? Right, like we said earlier, you need to have built something with the money that you have raised to make it attractive for the next set of investors. So whatever the startup has in mind, do we think that it is something that the next round of investors would get excited about? Or should we recalibrate some of those things? Right? Because the founders may think that, hey, this is good enough, but then we might probably say, no, we've spoken to 5 different VCs. They want to see something different, or they want to see something more, right, than what you are offering. Thereby, can you tweak it a little bit? We will probably say, okay, do you need a little more money to do it? There have been instances where we've told founders that when founders come and say they need only 3 crores, right? But what they wanted to do with that 3 crores was not going to be sufficient to get the next round of investors excited. So we said, okay, we'll give you 5 crores, right? Build this out so that you are at a better position to go out and raise the next round of capital. So all this, the team is the core focus, but in addition to that, understanding the technology, understanding where the differentiation is, what is the market situation like, what is competition like, then figuring out what do you want to do with the money, what is your business plan, what do you want to do with the money, and whether that will help you raise the next round of capital. These are just some aspects. There's a lot more deeper, but these are some aspects that we look at.
Got it. And you also mentioned about raising the next round of funding, right? So there are different kinds of funding, like seed funding, Series A, Series B. Could you help us understand what's the difference between all these?
So at a fundamental level, these are essentially different rounds of funding to support the startup as in their journey of growth, right? Think of, in India, we also use the word pre-seed. The pre-seed is essentially something that comes from incubators, accelerators, friends and family, angel investors, so on and so forth, where using that money, you would probably do, like I said, a working prototype of sorts. Then you come to a seed stage investor or an early stage investor. Then you go to them and say, hey, I've built this, so give me more money so that I can build possibly a working product, and then I can go and put it to customers. I can get feedback from them. I can build out a larger team, so on and so forth. That is what that money, the seed money, is usually used for. Then with that seed money, you then build out a product and then go to the next set of investors and raise what is called as a Series A. Right? A Series A is a larger quantum of capital, where then you're saying, hey, I've identified what my product does. I've identified who my customers are. I've built a team around me, and I've possibly started doing some very early revenues by giving this product to 1 or 2 customers, or maybe a little bit more. Give me more money because I have all these things figured out. If you give me more money, I can grow my team. I can put more customers. I can bring in more customers. I can build more products and do more sales and bring more revenue. Thereby, the value of my company increases. Right? So you raise a Series A round of funding with that. Then it goes on to say Series B, C, D, E, and F, which is all very similar, saying I've done something. Give me more money. I will accelerate it and do a lot more. Right? That's essentially how the curve grows. At some point of time, the money will also be used to make different products, right? Let's say, for example, a company like Razorpay might have said, I want to do only a payments platform at the very beginning. Then they will say, okay, I'm building the payments platform, but I can also capture other parts of the value chain. So they'll say, okay, I'll make a payroll software. I will make a reimbursement software. They'll do all those things to diversify their product offerings, thereby capturing more of that particular market. So some of the funding will also be used for doing some of these. You can also say that I want to raise a Series C round or Series B or a Series C round because I've now penetrated the Indian market. Now I want to go to Southeast Asia, right? Because there is also a similar ecosystem there, a similar set of customers. So money can also be used for global expansion. Right? So these are different facets of how the funding can essentially go in. But the lines of what a pre-seed round is versus what a seed round is, what a Series A is a little blurry. Right? In India, we also have a pre-seed, a pre-A. We also call it a pre-Series A round, so on. Essentially, these are different stages of funding to get different amounts of capital to accelerate the growth of the company. Right? That's the simple way to think of it.
Got it.
And at some point of time, you might also infuse a certain amount of debt, right, from banks or so, right? Because you don't want to dilute your company. You don't want to give ownership away at every point of time. You might say, okay, I can take, once I've figured out my product is working, my customers are there, revenues are coming in, I will say, okay, why don't I go to a bank, right, and get a certain amount. I'll get a few crores from the bank. The money from the bank can help run my operations of the company, so that I reduce the amount of ownership of the company that I'm giving away, because I know that the money is going to come in from a bank. I know the money is going to come in from the customer. So I'll take the money from the bank, sell the product, take the money from the customer, give it back to the bank, right? So that way I'm able to fund my operations effectively easily, right? So you will do a combination of debt and equity at a certain point of time.
Got it. And when VCs are sourcing deals, right, how often does it happen that you would have to approach the startup or the startup approaches you? How does it work?
It's often always a mix of both, right? It's always a mix of both.
Okay, so in that case, how do startups figure out about you, and how do you figure out about the startups?
Yeah, I think today it's a lot more easier because VCs are always out there. Like there's always news and articles out there and so on. But accessing a VC there are certain open channels. There are certain channels where it will be a little more difficult for you to access them. Not difficult, but it will take a little more effort to access them. Let's say, for example, with us as a firm, if you go to our website, there's a pitch form, right? Like you can fill up that form. We get an email. If we like it, we write back to you and say, can we get on a call and can we talk more? We also have an email address that is there if you want to directly send out an email, right? So we have something like that. But otherwise, it may be that, a lot of founders write to us on LinkedIn directly, right? They say they perhaps don't see the website, or maybe they prefer that they want to write to an individual and not necessarily to a generic email ID or a pitch form. So they can write to us on LinkedIn saying, hey, this is what I'm building. Hey, this is a small video of a product that I have, or a pitch deck that I'm sending to you. Why don't you can you have a look and let me know what you think of it, right? Or can we get on a call and speak more? So those are different channels that are available at this point of time. Now, I think because technology is so democratized, I see sometimes founders just writing to VCs on Twitter, right? Saying, hey, I've built this. They tweet out something and they tag a VC there and say, hey, why don't you have a look? Does this excite you? Can I get a meeting with you, right? All those things happen, right? So that's essentially how VCs largely reach out. Startups largely reach out to VCs today. Some others, we've seen cases in the ecosystem where both in India and abroad, where VCs don't put their contacts directly out there, or the firm does not put contacts directly out on a website or so on. They suggest that you get an introduction from somebody else, right? Somebody whom they know and trust. Right? They prefer that because then somebody else is validating this, right? Because they're not, the person who makes that introduction will be very careful about whom he or she introduces, right? Because their reputation is at stake, right? So in a way, it does a layer of filtering for the VC firm even before it comes to them, right? And if it comes from a trusted source, then a VC is more likely to act on it than otherwise, than if it comes as a cold message or a cold email, so on and so forth, right? So if someone tells me that, hey, this is an interesting startup, I've seen these guys, I really like them, why don't you have a look? I will obviously put a lot more weightage to that than necessarily an email that comes and lands into my inbox, right? So that's the other way that startups figure out a way to reach to investors. They see who is a common connect, or someone whom the fund knows well, and ask them for an introduction. Right? It may be a little long drawn, but it has a greater chance of going through than otherwise.
Got it. And you spoke of pitches, right? Like what makes a pitch stand out? And also, has there been a case where the idea is okay, average, but the pitch is extremely good?
Yeah,
and you like it, and so you invest in it.
Yeah, I think it translating into a great pitch, translating into there is a lot that happens between a great pitch translating into an investment, right? So, like you said, there might be an idea that we may not be supremely excited by, but by the way, all this is relative, right? What I find exciting might not be exciting to somebody else, and vice versa, right? So if I may really like the storytelling capabilities of a founder, right? I may really like the pitch deck, right? What that does is that it probably pushes me to spend more time, right? A great pitch in itself will not translate into an investment, right? I am not going to be so wowed by the founder that I let everything else go, or all the rest of my due diligence fall apart, and or keep the rest of my diligence aside and say I really want to invest in this company, right? So that is highly unlikely to happen, right? As a VC firm. Now, your earlier question on what sort of pitches we look at, what makes them interesting, was that the question?
Yes. So it was more like how important is a pitch when you're coming to a VC?
Yeah, I think it's very important. I'll qualify that. It is very important to pitch the right idea, the right product, the right market, the right vision. Right? Should it always be should a pitch always be correlated to a pitch deck? The answer is no. Right? Does it have to be a PPT that you have to come and present? You have to wear suits and come and present? I would say the answer is no. Right? We want you to tell us about your story, what you really believe in, why you think you are best positioned to solve this particular problem, and what have you built so far? Why do you think this will go all the way along? Right? So that's essentially what we want to know in the first thing. The pitch deck is only a tool for you to land a meeting. Right? If you are sending it over WhatsApp, you are sending it over email, it is only the primary purpose of it is to get the investor excited enough to have a 1 hour conversation with you, or have a 30-minute conversation with you. Is it useful beyond that? The answer is yes. But in that meeting, in that first email, the job of the pitch deck is only to excite the investor. It is not to make them decide whether they want to invest in this company or not. That is not going to happen. Highly unlikely that investors will only listen to you for 30 minutes and they will say, here, take my money. Not going to happen, right? So they will do their own diligence processes. The pitch is only the beginning of the investment process, right? There's so much that follows beyond that. That's not to say that the pitch is not important. It is definitely important, right? A shabby deck or something where your formatting is not in place, or a pitch deck where a formatting is not in place, you've made spelling mistakes, all those things will bring more friction into me deciding whether I want to spend time on this or not. It might be a little. I mean, I understand that when I resonate and understand that when founders send something across, they want feedback, they like to know what we think, so on and so forth. But if we were to sit in, if you were to sit in the seat from a venture capital firm's perspective, for us as an organization, we look at close to 2,000 pitch decks / deals a year, right? 2,000, and out of that, we as an organization end up making about 5 investments a year. Like, that's the conversion, right? So every month, I am effectively looking at anywhere between 170 to 200 pitches a month, right? So that's a lot, right? Now I have to figure out, and I have the mental bandwidth and the capabilities only to spend time with a select few of them, because I have to do deeper diligence on all of it, and so on and so forth, right? So given that is the case, we have to we tend to be very picky with the investments that we go through, right? And we need to really be cautious of where we spend time and where we choose to deep dive, and so on and so forth, right? So the pitch is only the starting part of it. Most of our time should be spent on due diligence, and not so much on figuring out that it's honestly in India today, coming down from 180 to 200 a month out of those 2,000 startups, bringing them down to about 200 really good startups is not a very difficult job, right? High quality startups where we see a market, where the team is great, there is a founder product fit, there is a founder market fit, right? It is very clear why you really want to do this. It's not very difficult to bring it down from 2,000 to 200. That is.
Got it. And how do we decide the startup valuation numbers?
Yeah, I think valuation is more of an art than a science. I think it's a fairly, this gets said a lot, but very honestly, I think it's more art than a science. The reality, I think, is that it's much more easier, or rather, it's a little more straightforward to do valuation at the later stages of a company, because then the revenue. You can say, okay, this is how much the company is earning now. If they grow at this particular rate, if we give so much money, they will grow at a certain rate, and thereby they will become a larger company, and so on and so forth. At the early stage, it's honestly not very clear, right? There's no clear roadmap or a rule or an Excel formula to say this is how I will value a startup, because almost everything at that stage is intangible, right? You cannot measure those things. In my eyes, this may be a great founding team. In somebody else's eyes, it may be an average founding team. How do you put a score on that, right? In your eyes, you may feel that this market is going to explode in the next 5 years. In my eyes, it will possibly explode, but it will possibly explode only over the next 10 years. And in my eyes, probably the explosion will happen only 3 years from now, not from today, right? It'll probably happen only 3 years from now. So how do you put a number on that, right? How can it's very subjective in a way, right? So what we look at, if again taking the lens of a VC firm, for VC firms like to have ownership in the company. We end up optimizing for our ownership. Let's say we want to hold 15% in the company. We have a certain cap on how much investment we can make in a particular startup. Let's assume that is $1 million today, right? Let's assume that I can only invest only $1 million in a particular startup in the first round. right? And I want 15% or 20% equity. Right? Let's assume 20%. The math is easier. Let's say I want 20% ownership in the company. I want to invest $1 million. Then automatically $1 million is equal to 20% of what number, which is $5 million. That's how the valuation essentially ends up getting decided, right? Because this is my capability, this is how much I want to own, and thereby the valuation is 20% of $5 million is $1 million, which is the amount that I'm putting. That's the way it ends up getting decided. There is no formulaic approach to something like this at this point of time. Does this mean that we cannot put an intangible on this? We definitely can, right? So sometimes if something is absolutely stellar, let's say that the founding team is absolutely stellar, right? They've spent 20 years doing this. They have all the necessary capabilities to take this startup to great heights. And let's say if another team were doing this, they would probably take 2 years to do the same things. But this particular team, because they've spent so much time in the industry, so much time in academia, they know this subject matter so well, they'll probably take 1 year to do this, right? And thereby I will see, okay, we are saving 1 year in doing this entire thing. Then I will say, okay, maybe I don't want 20%. I'll probably take 10%, right? And then I will give this company a higher valuation because they're very deserving of it, right? Then if I take 10% ownership and put $1 million, then automatically the company gets valued at $10 million instead of $5 million as previously, right? So these are calls that the VC can make at the end of the day, right? The VC can essentially set the number, right? Of course, you have to justify it in some way or form, right? That also has to be there, but it's not uncommon for someone to raise, for a VC to say that I will compromise on something because something in the deal really stands out and I really want to be a part of that deal. What happens also is that if let's take that example of these stellar founders that are there. If they're stellar founders, then there will be a lot of people who would want to work with them, right? There's automatically competition comes in, and competition drives up prices. That's the way to think of it, right? So let's say somebody really wants to work with them, and they say, okay, instead of $10 million, I'm going to give you $15 million valuation, right? Justified, not justified, what is the approach? Doesn't matter. The founder will say, okay, let me take $15 million, right? Because somebody is willing to give me that, right? Competition makes it possible that the valuation of the company can go higher, right? At the same time, if nobody is valuing that company or nobody is interested in that company, then whoever is coming in will say, hey, it seems like you've spoken to 50 investors. Nobody seems to be interested. Why should I give you a $10 million valuation, right? So they'll say, okay, I can only give you $6 million. And I need, let's say, I can only give you $5 million and I need 20% of the company. Or they'll say, I can only give you $3 million and I need 33% of the company. Whether the founder chooses to take it or not is secondary, right? They can see if that's the right deal for them or not. But this is how market competition and how many people are involved in the startup, in evaluating the startup and showing an interest in the startup can also decide how valuation happens, especially at the early stage when there is lesser data to go on for, right? If the company is making 100 crores of revenue, somebody says, okay, this company can only be valued at 1,000 crores, 10 times the revenue is the value that I'm attaching to this company. Somebody can also come and say 100 crores, 100 times the revenue, right? That's also possible. But because there is a certain number involved, there is some rationality that comes in, or there is a certain formulaic approach that comes in. Here, not to say that it is irrational, but there are a lot of intangibles here, right? And thereby that starts reflecting in the valuation number as well.
Got it. And so one interesting question that I have is, what is a common misconception that the startup founders have about VCs that you would like to correct?
I think founders, to go back to one of your earlier points, they think a great pitch equals that I will get money, right? I think I've observed this a lot amongst founders. They think that because the conversation between a VC and a founder goes well in that meeting, they translate it to that the investor is interested in investing in the company, right? It perhaps that's not necessarily the case. That's almost always not the case, right? Because a meeting might go well, right? I might ask you questions, you might answer, right? Sure, did it go well? The answer is yes. Does that necessarily mean that you have a commit from me that I will invest in the company? Possibly not, right? So the other thing that I've noticed and what founders think is that that valuation, higher the valuation, the better, right? Again, not always the case, because you always have a risk of the company being overvalued, right? Let's say, for example, if I were to elaborate on that, let's say you raise $1 million and say you want to meet targets ABC. That is why you're raising $1 million. And for some reason, the valuation that the investor gives is about $10 million. Now you achieve ABC, and then you go to the next set of investors. The next set of investors are going to say, hey, for these milestones, I can't give you more than, let's say $12 million, right? Because these milestones are, if you reach these milestones, in my head, they are only equivalent to $12 million. But you had previously raised only at $10 million. You had previously already raised at $10 million. Now it's only a $2 million jump in your valuation, right? So that may not be good enough. There have also been cases where we've seen the company, the next set of investor this is actually a better case, right? Where somebody is saying, I will actually value it at $12 million, which is more than your previous valuation. We've seen cases previously where the founders, where the investor comes and says, boss, for these milestones, I can only give you $8 million, right? Because somebody made a mistake, or in their lens, right? In the next investor's lens, they think that the previous investor should not have valued this company at $10 million, that it is not worth so much at that point of time. And today it is worth only $8 million. What if they say that? Then you're facing a down round, right? Which is essentially that from what your company was valued 12 months ago or 20 months ago, you are now valued much lesser, which means the value of the equity, the ownership, the shares that somebody holds, both the founders and the VCs, it has gone down, right? You now own 10%. Let's say as an investor, I now own previously owned 10% of a $10 million company. Now I own 10% of an $8 million company, right? Which is lesser, right? So over a period of time, the value of my money has gone down. It's depreciated, right? Which is not favorable for me. Right. So anyways, the broader point is that founders overtly optimizing for valuation at the very early stages, I think is something that we've seen happen, right? Less so in deep science and deep tech, because founders understand the journey is hard, but it happens quite commonly, I think, otherwise. What else are founders' misconceptions, right? I think there is also this view that VCs will essentially run the company in some way, right? Like, just because you are investors, there are actually two ways of thinking about this, and we've seen examples of both, right? We've had founders who've essentially come and said, hey, we know technology, you guys know the market, you guys know the business, you are investing in us, you will be running the business, right? Essentially, like, you will be taking care of customers, conversations and all that. We know how to build technology, right? So, that's one lens of it. The other lens is to say that now that you've invested in the company, I will come to you for anything and everything, right? While forgetting the fact that 80% of the company is still in your hands. You have more skin in the game, right? We own only 20% of the company. The reality is that we are buying into the vision of the founders as VCs. We are saying that we like what you're building, we want to be a part of your journey, and thereby we are giving you a certain amount of capital and getting certain amount of equity. You still have to run the company, right? Yeah. Otherwise, the value of all of that is going to crash down, right? And we are not operational investors. We are not going to come and run the company in that particular case, right? And yes, we will help you out in certain decision making, but we can't We can't be there everyday operations. You can't come to us and say, hey, can I spend 2 lakhs here? Can I spend 5 lakhs there? That's not our job. No? That's your job to figure it out, right? Because it's your company primarily. So I think the view that that VCs will run the company for them / that I have to go and get the consent and approval of anyone of all these VCs is something that I've seen a fair bit happening in India. But otherwise, I think the other thing that I would actually I've seen founders do, which is a little in all frankness waste of everyone's time, is that they want to pitch to investors irrespective of whether that investor invests in that particular sector or not, right? So doing some level of homework on what the investor's investment thesis is, or what sectors do they like investing. For example, for us as a deep science and deep tech focused fund, we will not invest in D2C brands, right? But I can still show you about in this over the past 2.5 months in this particular year. I can show you at least 10-15 companies, D2C companies, who would have come and written to me saying, can you invest in us, right? When it is plainly clear, if you go to our website, that we would not do it, right? So this approach of just sending that pitch deck to anyone and everyone, right, and hoping that something works out, while I understand the strategy, it's not the best use of one's time, in my view, right? So doing some amount of homework on what the investor likes, what do they not like, I think is appreciated, right? So that it honestly saves a lot of time for all of us.
Got it. And we spoke about where we're getting the money from and how we are investing.
Yeah.
And now let's talk about how we exit from a specific company, right? What are the common exit strategies that VCs use?
Yeah, I think okay. Let's there are a couple of layers of the answer here. We come from a background, like I come from a background of investing in deep science and deep tech in India, right? That's what our firm does. There are other sectors, other technologies that people can invest in. Deep science and deep tech by nature takes a longer period of time, right? It requires you to put in a lot of money and lot of time and effort even before you have a product in place. So exits are not something that happens in the immediate time horizons in deep science and deep tech, right? It can take 4, 5, 6, 7 years for you to exit. What does an exit mean in this particular case is your ownership is, you are transferring your ownership to someone, right? The shares that you hold in the company, somebody else takes it up, right? Or you give it away to someone. That can happen in multiple ways, right? One is, let's say, a merger or an acquisition happens, right? Another company which finds the products of our invested company finds the products useful, and they say, you know what, we will acquire this entire company, their products, their IP, their products, their team. We will take it within our company and we will build something along with it, right? Within the company, right? So thereby that company takes the ownership of the company that we've invested in. Thereby our shares are bought by that particular company, hopefully at a valuation higher than what we invested in, so that our money grows, right? Now that's the merger and acquisition is one part of it. The other is, as the company, assuming that the company is growing well, right? Let's say the company has raised a Series B round, right? And let's say I was the first investor in the company. I have been in that company's journey and I own a certain percentage of the company till their Series B round, right? At Series C, I see that the valuation of the company is very high and they are raising only a certain amount of capital. There are a lot of people interested in investing in that company because the company is doing well, but there are only so much equity or so much shares that are available to buy at this point of time. So I will say, hey, forget about the new shares that are available to buy. I will give away some of the shares that I own today, right? It's like how I would divest my mutual funds or something, right? So I won't give away everything, but I will give away, let's say, 20% of the ownership that I have in the company. And why don't you buy it from me rather? So thereby, I am getting capital, I'm getting money for the ownership that I had that I'm giving away at this point of time, right? Or rather selling at this point of time. So that's essentially what are called as secondary sales, right? They're not primary sales of ownership or shares, but they are secondary shares of sales that secondary shares that are getting sold. The last is when there is an IPO of sorts, right? Where as an investor you stayed long enough in the journey, and essentially when the company goes for an IPO, you get to divest your investments. Right? That's the way to think of it. In the world of deep science and deep tech, the ecosystem is fairly nascent in India at this point of time. So we've not seen a lot of exits happen yet, right? The companies are still building at this point of time, but very likely that and we have seen examples of these acquisitions happening, because whatever these companies are building is significantly useful for somebody else, because there's a certain IP, there is a certain uniqueness to the product that is being built. So somebody else finds it attractive and useful. Thereby, they go and acquire this particular company. So the acquisition route has been more common in deep tech, although very less. It has been the more common one as such.
Got it. And has there been an instance where the startup did not meet your expectations but has taught you something very valuable until now?
Happens all the time, to be honest. Like
your favorite example.
The nature of a startup is that things will go wrong, right? If everything goes per plan, there is possibly something wrong with the startup, right? Like, because there is so much uncertainty, right? You can't be so good that you plan everything on the dot and you use money on the dot, so on and so forth, right? So more often than not, things will not go as per plan, right? Then the way to look at it is that you try to catch that as early as possible. As responsible investors, we should see if the direction that the startup is going is deviating from the original plan that we had set across, right? If there is a deviation, we need to recalibrate very quickly and ask ourselves, why is that happening? Is it happening because for example, the technology that you promised that you want to build is not you're not able to build it in that way, right? Maybe something is going wrong, right? You perhaps don't have the right people. The people whom you've hired are not performing in the way that you want, or let's say the components are available, they are not available, right? So something is happening that is making you deviate from your original plan, right? At that point of time, you have to figure out what are those pitfalls very quickly and try to recalibrate and say, okay, can we get back on the original path? Otherwise, then you have to be intellectually honest and say, we tried this, seems like this is a dead end, and then say, okay, maybe this is not for us. We have to shut shop, right? We have to say this is not working, or you do a pivot, right? You say, okay, I was doing X till a certain point of time. Now I'm realizing that the X that I was developing is either technically very difficult, or maybe something has changed in the market. Maybe there are 10 other people who now started giving the same X. So there is no point in me spending one more year using VC money and building the same thing. So then I will say, okay, can I do X1, X2, X3 or some variant of X where I have a certain unique positioning out there. So pivots are also fairly common, right? Like we see a lot of startups whom we would have seen like 3 years ago. Like I would have spoken to them 3 years ago, and when they come to me now, they're something very different from what they were previously, right? So those recalibrations happen quite often, right? So it's not an uncommon thing. It's not something to be frowned upon. The most important thing is that there's an opportunity cost. How long can you take to figure this out? Right? And thereby, in the time that you are figuring it out, is someone else actually going to build it and take that position sense. that you would have otherwise taken, or you would have wanted to take yourself, right? The opportunity cost is the thing that's the most important from a startup perspective. From a VC perspective, I would ask the same question to say, let's say I invested 10 crores in a particular startup and that has not gone as per plan. So 10 crores of my money sitting in the startup's end or being used by the startup for 1.5 years, 2 years, and they've not gone where they wanted to be. Now, my opportunity cost is that man, could I have invested the 10 crores somewhere else, right? Where that money could have made a lot more, could have helped a startup do a lot more progress, right? That's my opportunity cost. That 10 crore I've invested, but could have gone somewhere else where it could have made more substantial, tangible impact. Right?
And okay, so the exit strategies are for good case scenarios, right? But what if a startup completely shuts down or fails? What happens then?
Happens more often than not, to be honest. Right. Thankfully, so far we've not had any casualties in our portfolio in that sense. But we have to be honest and say that's an exception, right? Like having less casualties or having no casualties is not a common thing, right? It is common to see startups actually shut down. What happens in those sort of cases is that, again, a couple of things. One, you do something like a distress sale, right? Like, let's say your company was valued at $100 million. You say that, and you're not achieving product market fit. Your whatever tech you've built is not performing effectively, or competition has come in, something has happened where you're not able to do what you wanted to do, right? But your company is valued at $100 million. Because what you're doing is not so effective in some way or form, nobody wants to pay $100 million to you, right? For the startup. They're going to say, hey, I can pay only $20 million, right? So you are at that point of time, you do a distress sale, right? You say, okay, fine, let's at least make some money out of it. It's not $100 million, but at least let's make $20 million out of it. And then you go through that sale, right? So there is an M&A or an acquisition that happens, but at a much smaller quantum than what you would expect. That's one way. The other is the investors say, so the startup founders essentially say, hey, I raised 10 crores, right? I've worked on this for, let's say, 1 year. I've spent 4 crores of capital. There's 6 crores still in the bank, but I don't think this is going anywhere, right? I can't do anything about the 4 crores that I've spent, but the 6 crores, I'm just going to give it back to the investor. Right? Just take it, right? Like I tried something, it didn't work, and I have to be honest. I have to be intellectually honest and say it's not working. So I don't want to waste more of your money. I'm just going to give back money to whatever money is left. I'm just going to give it back to you. Right? That can also essentially happen. Or there are also cases where the founder just runs out of money and one fine day just says I don't have any more capital, and let's say you just sell whatever assets you have, like you have some furniture, you have some testing equipment, you have some machines. You just say, I'm just going to sell whatever there is, and whatever remaining, if I have taken debt, I just clear off that debt and I just go back home. And in that case, everyone ends up losing.
Got it.